Good evening, everyone, and welcome. Winter is over and spring has sprung, sort of. And for their parts, stocks sprang, as in sprang back from yesterday's losses. The chill that Fed Chief Janet Yellen put into stocks yesterday when she hinted that interest rates might rise sooner than expected next year was all but gone today. Equities got a boost from some better than expected economic data. The Philadelphia Fed reported a boost in business activity in its region this month, and a private reading on leading economic indicators was higher in February. And even though jobless claims rose by 5,000 last week, the increase was less than expected. So the Dow was up by about 108 points. The Nasdaq and the S&P both added 11.
But even though stocks ended higher today, the threat of rising interest rates is still worrying many investors. What does it mean for their stock portfolios and for their fixed income holdings? Dominic Chu has more on what a hike in rates, if it happens, could mean for your investments.
For many economists and investors, rising interest rates are a sign that markets are getting back to normal again. But if interest rates rise, there are going to be benefits and drawbacks. For one thing, higher rates means that bond prices go lower. Be sure to keep an eye on that part of your portfolio. That leaves the other big asset class, stocks.
What we're seeing is a lack of commitment on the part of many investors to the stock market, even though we are 5 years into this bull market. And what we'd advocate is for investors to recognize the importance of remaining invested despite short-term turbulence.
So, where are the attractive places to invest in the stock market? The places that actually benefit when rates are on the rise.
I think the sector that's going to benefit most from a rising interest rate environment is definitely the financials.
The thinking is that traditional lenders like commercial banks can borrow at cheaper rates in short-term markets and then lend that money out at higher rates to customers. The wider that gap, the more profit for banks. Then there's the technology stocks, some of which have compelling cases for investment.
If you look at Cisco, Intel, Microsoft, these really old, stodgy technology stocks that haven't moved in years are now starting to pick up because people are saying, well, hey, I kind of get the best of both worlds here. They're companies with no debt, so they don't have to borrow if interest rates go up. I'm actually getting a really high yield if I'm looking at some of these over 3%.
But not everyone believes that we're destined to see a steady march higher for interest rates. Economic concerns still linger.
Inflation's very low in the U.S. It's barely 1%. It's even lower in Europe and falling. So it's really hard to make the case that the Fed is going to be raising rates aggressively.
That's why many financial advisors are telling their clients to spread their bets and build diversified portfolios with exposure in all different kinds of asset classes. For Nightly Business Report, I'm Dominic Chu.
Joining us now to talk more about rising interest rates and what it could mean for your investments is Brian Jacobson. He's Portfolio Chief Strategist at Wells Fargo Fund Management. Brian, welcome. Good to have you with us.
Thank you.
Did you think yesterday's comments by Janet Yellen were kind of pants on fire moment the way the markets did, or was it an overreaction?
I think that it was kind of an overreaction by the markets. Admittedly, though, this was her first press conference, and some of her responses seemed a little bit muddled. So I think she could probably do a little bit better job in communicating with investors. That'll come with time, though. The big problem was that it appeared as though the Fed is being overly what we would call hawkish, that is too concerned about perhaps potential inflation down the road, and that they might start hiking rates sooner than what everybody else was expecting before going into the meeting.
But in a lot of the analysis today, Brian, I mean, if you look at what she said, if the economy does improve, if the Fed continues to taper back on its stimulus in a gradual, basis, and interest rates also go up slowly and steadily, is there any reason that this should be traumatic for stock investors?
Absolutely not. And actually, in fact, given that Janet Yellen effectively said that by the time the asset purchase winds up, which might be in the fourth quarter of this year, that it would take another 6 months at least before we would actually see the Fed start raising rates. Keep in mind, there were a lot of ifs and buts surrounding her forecast of saying that they might start hiking rates in about 6 months. It all depends upon the inflation outlook. The Fed right now, there's not much they can do to help support the labor market, so they're shifting their attention more on inflation, and that really doesn't look like there's a lot of pressures building to drive that much above what their target is.
Can't slightly higher inflation be good for stocks, and can't slightly higher interest rates actually benefit some types of stocks, some categories?
That's correct. And actually, slightly higher interest rates across the board could probably be beneficial for a lot of the stock market and even the fixed income market. It all depends upon the parts, because when interest rates rise, it's important to note that they don't rise uniformly. That is, you don't see Treasury bills rising at the same pace as you do a 30-year Treasury or corporate debt. So we don't oftentimes see all the rates rise together. In fact, if you looked at how the market reacted to Janet Yellen's comments, the 30-year Treasury, the yield on that actually dropped. So even though we saw 2-year Treasuries go up in yield, 30-year Treasuries went down, it could actually be pretty good for investors who are in some of those longer duration securities.
So, Brian, if you want to make some changes in your portfolio, what areas should you go into? You heard Dominic's package. He was talking about financials and also technology stocks. I know those are big, big areas, but do you agree with that? And also, what else would you add on the list?
It all depends on the context, and actually I disagree with the financials, mainly because in this environment, banks are effectively borrowing for very low interest, effectively for free, and lending at a higher rate. When interest rates do begin to rise, I don't think we're going to see those lending rates rise as quickly as the bank's borrowing rate. So it could actually result in a crimping of their profits. So from my perspective, I would actually be shying away from some of the banks because I think their profits are going to be hit a little bit. Information technology tends to be a very good area. You don't have very highly levered firms there, and oftentimes when rates rise, it's because economic growth is picking up, and that's good for information technology stocks.
Very quickly on dividend-paying stocks, might they sort of lose some of their mojo if interest rates go up? Very quickly.
They can. Interest rates, when those go up, dividend-paying stocks tend to act a little bit like bonds in that case, where interest rates go up, prices drop. So that would be an area that I would be underweighting, like utilities and telecoms.
Brian, thank you so much. Brian Jacobson, Chief Portfolio Strategist at Wells Fargo Funds Management.